we wanted to check in with Chris Whalen. He is co-founder and managing director of Institutional Risk Analytics. His firm analyzes financial risks based on FDIC data. He was previously an analyst at the Federal Reserve Bank of New York. Many other titles, but we actually don't have time to go through all of them. All we can say, Chris, is we're glad to have you here on set with us.
Thank you.
So what do you expect to hear? I mean, we've been bandying about this number of 1,000 banks possibly failing.
Yep.
Sort of between what we've seen so far, the 124 we've seen so far, it seems like 800 plus to go. Do you still think that's the right amount?
Definitely. We rate all U.S. banks, and right now we've got about 2,200 that we rate F. We think about half of those will be okay, and the other half are eventually going to be restructured or sold or both.
You've been somewhat critical in the past, saying that the government should be doing more. You're sort of one of the few voices out there saying that as far as supporting banks go. What do you think should be done?
Well, not so much government support for banks. I think we should be restructuring them. If you don't restructure the bank, it can't lend. The banking system is shrinking by about $200 to $300 billion a quarter. That means they're not growing their loan book. If we don't stop this silly socialist nonsense of subsidizing the bondholders of the banks and essentially saying, oh, you don't have to take a loss, then we're going to be in big trouble in the economy. There won't be any credit for the real economy.
Chris,
oh, sorry, go ahead, Erik.
No, just do we want that much more credit? I know that sounds like a crazy question, but credit was what fueled the boom that we could not sustain. Do we really want to see that much credit come back?
Well, you don't want to go from 100% to zero. And that's essentially where we are today. Not just banks, but if you look at a much more important indicator, vendor finance. Vendor finance was 3 times the banking loan book a year ago. It has shrunk by 3/4, according to my friends at Credit Risk Monitor. So what I'm saying to you is that we stabilized the banking system this year. We need to declare success, let the TARP expire. Now we have to ask ourselves, how do we get these banks so that they can actually finance real economic growth again? And that means you have to restructure them.
So what's the best thing for the banking sector that we could hear from Sheila Bair today?
Well, I think she's going to tell us that there are more troubled banks and that we've got more resolutions ahead. I don't know what else she could say because I think that's what the data will show.
But is the FDIC downplaying the severity of the banking crisis in as much as you're rating 2,200 banks in F? Yeah. The FDIC is not going to go anywhere near 1,000 in terms of the number of troubled banks it identifies.
They could get up to close to 500 this quarter. I don't know what the number is. But look, the industry's trying to buy time. Forbearance is the name of the game right now. My guess is that about 1/3 of charge-offs, 1/3 of non-performing loans are actually not showing up in the data right now because the banks are desperately trying to slow down this process. They can't resolve everything in a quarter. And that's what's going on now. You have huge forbearance for all sorts of customers, and banks are essentially turning into REITs. They're becoming operators of real estate. And there's not much choice because there's no buyers for a lot of this collateral.
If the banks restructure, as you propose, I mean, who pays for this kind of manpower to get it done? I mean, the FDIC, we know, even sort of is running a little short on cash itself.
No. That's a complete misnomer. The FDIC doesn't run out of cash. They have more than enough cash to deal with the problem. And the question is, how do we finance it? I have a piece that was in the Bank Credit Analyst last month where we estimated it could be $300 to $400 billion worth of cost that the banking industry is going to have to repay. That's going to come right out of investors' pockets. So before the investment community can say, hurrah, we're out of the crisis, we have full access to the earnings of these banks, we have to look at all of the things that they're going to have to repay. Higher capital, repaying the Deposit Insurance Fund for the cost of resolutions, as you were saying. All of these things are standing in front of investors right now. And that's one of the things I've been trying to get my clients to understand. 2010 is going to still be about cleaning up the mess, and even going into 2011.
Are there not some pros and cons, going back to forbearance for a moment, about forbearance, the idea that if you are able to float the bank, so to speak, for a long enough period of time, maybe the assets will come back in value and maybe the banks will return to more or less healthy capital ratios?
Well, that's a lovely sentiment, but if you go back to the 30s, if you look at the way Jesse Jones handled this problem when he was head of the Reconstruction Finance Corporation, yes, time is our friend. We do want to buy time, but you don't want to ignore insolvency. Because we have about, I don't know, half, maybe 60% of the banking system now that is shrinking. These guys are not making new loans, and until we recapitalize them, until we charge off the bad loans, we're really not going to make any progress. And this is why it's so interesting, this discussion about convertible debt. I think is a very good idea because it says, well, we don't have to take Citibank apart. We don't have to liquidate Citibank. We'll have a partial liquidation where we convert debt to equity. We charge off $200–300 billion at Citi, clean up the mess. And by the way, you've also dropped their interest expense for the bank. All of a sudden, that bank is solvent. It has 12–15% capital. They can lend you money again.
Chris, we have to leave it there. We thank you.
Thank
Chris
you.
Whalen, institutional risk analytics.